Namaskar friends, welcome to the channel JIV and CIV Made Simple. In this video, we are going to cover our CCP, that is Certified Credit Professional, memory-based question with an explanation for the examination which was held on 9th May 2026. So, obviously, in our channel, you will get more such previous year question, and this will help you to gauge what type of question are being asked in the examination so that you can prepare accordingly. So, let's get started with our very first question, which is based on A and BC computation, or we call it adjusted net bank credit computation. So basically, let me give you an example. So imagine that you have 100 rupees to lend. Okay. So the Reserve Bank of India act like a strict parent and say, out of this 100 rupees, you must lend, how much? 40 rupees to the important areas like farmer, poor student, small businesses. And that is called, priority sector lending, as you know it very well. But here is the catch. 40% of what exactly? Yeah, 40%. When I say 40% of what? So, first of all, bank take it. So basically, let me first take you the question, right? So the question is that according to the RBI master direction on PSL, bank are required to meet their PSL target as a percentage of ANBC. You know it very well, or COB, whichever is higher. So which of the following component is added to the net bank credit when calculated the ANBC? Yeah. So so they have given the four option, and you have to tell which are added to the net bank credit while calculating ANBC. Option A: bill rediscounted with the Reserve Bank of India. Advance made strictly to other scheduled commercial bank. Outstanding deposit placed under the RIDF or other eligible fund with NABARD, NHB, SIDBI, Mudra. Provision made for non-performing asset and bad debt. So these are the four options they have provided. So friends, you can think of NBC, that is net bank credit, as a total genuine loan given out to the public. So let me give you a simple example to make it crystal. So you can think of NBC as the total genuine loan. Okay. Total genuine loan which you have given to the public. Okay. So because it is only for the public, we strictly remove any loan given to other bank. That's called intra-bank advance. And we remove bill rediscounted with RBI. So you can see total genuine loan given to the public. So it is given to the public. We strictly remove any loan given to any other bank. But what if bank failed to meet its 40% target last year? Every bank has 40% target last. What if the bank failed to meet this? Right. So the RBI punishes them by saying, since you did not lend enough to farmer, you have to lock up that shortfall money in a special rural development fund like RIDF with NABARD. Right. So RBI punishes them by saying that you did not lend last enough to the farmer. So whatever shortfall money is there, right? Shortfall money has to be, lock up in a special rural development fund, right? Rural Development Fund, and the name of that fund they have given RIDF. With whom? With the NABARD. Okay. So to be fair to the bank, the RBI say, okay, since your money is stuck in this fund for a good cause, we will add this deposit back to your total credit base when calculating your target for this year. And that is how NBC become adjusted net bank credit. So this now after doing this, all this, NBC become ANBC, right? So now let's look at the question. The question asks which of the following, a component is added to the net bank credit while calculating the ANBC. So what option they have given? So the first option they have given is the bill rediscounted with the Reserve Bank of India and other approved financial institution. B they have given. Let me highlight the keyword bill rediscounted with RBI. Second they have given is the interbank advance. Third they have given provision for NPA. Here you can see. And last they have given outstanding deposit placed under RIDF. So friends, to remember this easily during your examination, just use simple memory hack minus bank plus fund. Just use this memory hack. What memory hack? Let me write down. Right. So while transforming NBC to ANBC, what we need to subtract? Minus bank and plus funds. Just remember this. Okay. So minus bank means what? Subtract any loan given to other bank or RBI. You have to subtract any loan. Subtract loan which is given to other bank or RBI. And plus fund means add any money stuck in the government development fund. Okay. So minus bank means subtract any loan given to other bank. And plus fund means add any money stuck in government development fund. Like any money which is stuck in RIDF, NABARD, SIDBI. Just remember minus bank plus fund, and you will easily spot the correct answer in A and B C calculation question. So what is the correct answer to this question? So if you look at the option they have provided, right? So yes, option number C is the correct one. This is our correct answer. Outstanding deposit. I told you na, minus bank, right? Minus bank plus fund. So basically they are asking you to add. What is added? So fund has to be added, right? So add any money stuck in the government development fund. This is the point. So what we have discussed. So what is the moral of the story? The moral of the story is that PSL, priority sector lending target are calculated as a percentage of A and BC. They are calculated as a percentage of A and BC or COB, right? Whichever is higher. First point. Second point, I told you that NBC, net bank credit, only counts public lending. Yeah, they only count the public lending. It is strictly exclude interbank loan and RBI discounted bill. Only public lending are there. Interbank loan and RBI rediscounted bill are excluded. And I told you that from NBC to ANBC, what we need to do, we need to add outstanding deposit made in eligible fund like RIDF, NHB, CDB, and Mudra. Right. So just remember this hack: minus bank plus fund. Okay. I hope that is crystal clear. Now, friends, let's switch our focus to the question number two. So the question number two is regarding the constitution of Cersei. Right. So basically, this is a very important topic, but the legal jargon can get confusing. So the question is, Cersei, full form, Central Registry of Securitization, Asset Reconstruction, and Security Interest of India. So the question is, this was established to deter fraud involving multiple lending, right? That is why this was established, right? To deter fraud involving multiple lending against the same equitable mortgage and to maintain a central registry of the, you know, central registry of the security interest. So the question they are asking that under which legal framework is the Cersei officially constituted, right? So option they have given a statutory trust registered under the Indian Trust Act 1882, a Government of India undertaking formed under the specific amendment to the Reserve Bank of India Act 1934, and a non-for-profit company licensed under Section 8 of the Companies Act, a multi-estate cooperative society registered under the Multi-Estate Cooperative Society Act 2002. This is a very good question. So basically, let me explain what is happening. So imagine there is a clever guy, right? Suppose there is a clever guy named Mr. X. Okay, you know what he does? He owned one house. Okay, he take the property document. He take the property document, and he goes to bank A and get a home loan of 50 lakh. Okay, so this person X, basically he take the property document, goes to bank A and take a home loan of how much, sir? 50 lakh. Then he create fake copies of those documents. Yeah, he created fake copies of those documents, walk into bank B, right, and take another 50 lakh. He does this again with bank C also. By the time bank realized that they have all lent money against the same house, Mr. X has vanished. Lastly, what happened? He vanishes. So, to stop this massive fraud, the government and RBI stepped in and say, we need a master ledger. What we need? We need a master ledger, right? A central database where every single bank must register their property loan. Yes, every single bank must register their property loan. And that master ledger is what we call the Cersei, right? That is Central Registry of Securitization, Asset Reconstruction, and Security Interest of India. Now, before any bank gives a loan, they just log into Cersei. If Mr. X house is already mortgaged with Bank A, it will show up instantly, and B will reject this loan. Yeah. So what bank will do? They will reject the loan, right? Because it is already mortgaged by bank A. Because on Cersei portal it will be visible. Now who actually run the database? Is it a government trust? Is it a cooperative body? Because Cersei is providing a public service, protecting public money, stopping fraud. It does not exist to make money. So therefore, it was established strictly as a not for profit. See the keyword. How it was established? It was established as a not for profit, right? It was established as a not for profit company. Okay. And in Indian corporate law, non-profit company are registered under the Section 8 of the Companies Act 2013. Please remember this. As per the Indian corporate law, non-profit company, not for profit company, they are registered under the section 8 of the Companies Act 2013. Now let's look at the question. Let's see the option they have provided. So option A, statutory trust. Let's talk about the statutory trust. This is incorrect. It is not a trust. B says that Government of India undertaking. Yeah, what option B says? Government of India undertaking. Again incorrect. While it helped the bank, but it was not formed under the RBI Act, right? Then the next point they have given is option C is non-for-profit company under the section 8. Yes, this is exactly correct, right? And what about option D? They have given that option D they have given a multi-state cooperative society registered under the Multi-State Cooperative Act. What do you think about it? Yes. So this is another. This is not a cooperative, right? So D is also incorrect. Now, friends, I hope the answer is clear. Answer is option number C. Okay. So please remember that Cersei. To remember in the exam hall, just think of the number 8. The number 8 looks exactly like a pair of handcuffs, isn't it? It looked like a pair of handcuffs, which we call in Hindi as Janjeer. So basically, Cersei's job is to put handcuff on fraudster who try to take multiple loan. So handcuff means section 8. And since police work, right, is not for profit, so it is a non-for-profit company. So section 8 non-for-profit company. So what we have discussed, that Cersei is stop fraud involving multiple loan on the same property. It is not for profit company registered under the section 8 of the Companies Act 2013, and it functions under the SARFAESI Act. These are the points which I have just made clear. I hope that is crystal clear now. Now, friends, let's switch our focus to the next question. Friends, before moving to the next question, let me introduce you to our CCP comprehensive course. In this course, you get unit-wise theory and MCQ PDF, previous year questions separate folder, videos, quizzes and mock test. Almost there are 63 quizzes covering each and every units. In addition to that, I provide you module-wise content as per the latest syllabus of the Taxman book. Right, there are almost 4 modules. In addition to that, you get quick revision PDF module wise. These are the short notes which you can go through the entire points. And not only that, I provide you videos also, videos explanation of all the content, all the PDF, right, in English, and at that too complete explanation of the entire concept. So if you want to get access to this course, you can just check out the link in the description section, or you can WhatsApp me on the number shown on the screen. सर जो नेक्स्ट क्वेश्चन है द नेक्स्ट क्वेश्चन इज बेस्ड ऑन द डिसएडवांटेज ऑफ द payback period, payback method in the capital budgeting. So first of all, the question is, while assessing a term loan proposal for a capital intensive manufacturing project, a credit officer observed that project has a very favorable payback period. However, relying solely on the metric for capital budgeting decision is highly discouraged. The question is, which of the following statement represent the most critical disadvantage of the traditional payback period method? Option A, it assumes that all the intermediate cash flow are reinvested exactly at the project internal rate of return. Option B, it heavily rely on complex discounting rate, making the initial appraisal process cumbersome for credit analysts. Option C, it completely ignore both the time value of money and any cash flow generated by the project. And D, it is mathematically incapable of evaluating project that has uneven or staggered annual cash inflow. Very good question. So friends, basically this is a question based on the payback period method. Imagine that you are a bank manager, right? And you are assessing a loan for a factory. The factory owner has to choose between two machines. So let me give you an example. So suppose there are two machines the factory owner has to choose between, right? Each costing how much? 1 lakh rupees. So this is machine A and this is machine B. So machine A generate how much? 50,000 rupees per year. Okay, this is what machine A generate, and it will recover 1 lakh investment in exactly 2 years. So 1 lakh you have invested, right? And that will be recovered in 2 years. And this is 50,000 rupees per year is what generation. It will generate this much. Okay. Now that is what machine A does. But after 2 years, you know what happened? That the machine breaks down forever. Machine breaks down forever for machine A. What about machine B? Yeah, machine B generate 25,000 rupees per year, 25,000 per year, and it takes 4 years to recover the 1 lakh investment. So 1 lakh invested, and it takes how much? 4 years to recover. Okay. However, the machine lasts for 10 years. Machine will last for how much? 10 years, generating massive profit between year 5, right, to year 10. Massive profit. Okay. So if you strictly use the payback period method, which only asks how fast do I get my initial money back? See, here you have invested 1 lakh, here also you have invested 1 lakh, but it is getting in 4 year, this is completely getting in 2 year, right? In exactly 2 year, that you will be able to recover the 1 lakh investment in 2 year, and it takes 4 year to recover the 1 lakh investment, right? But this machine lasts for 10 year, and it breaks down, right, forever. After 2 year, it breaks down forever. So if you strictly use the payback period method, which only asks how fast do I get my initial money back, so tell me, you would choose machine A. Why? Because it is taking only 2 year to recover your initial money, while it is taking 4 year. But wait, machine A stop working after 2 year, isn't it? It break down immediately, it stop working after 2 year, right, making zero profit, right? After 2 year, it makes zero profit because machine is not working. How can you make profit? But machine B would make you rich, right? Would have made you rich. So this is the biggest flaw of the payback period method. It completely ignore all the money you make after initial investment is recovered. Yeah, it ignored all the money that you make, right, after recovering initial investment. This is the biggest flaw. This was the first flaw. Second flaw is that it ignored the time value of money. This is another flaw, right? It ignored the TVM, right? Time value of money. Okay. The payback period method treats 10,000 earned today exactly the same as 10,000 earned 4 years from now. Right? It treats the same. Whatever 10,000 rupees you earn today, right? It treats it like same 10,000 earned, 4 years from now. But as a banker, we know that because of inflation, because of interest, money today is always worth more than money tomorrow. So now let's look at this particular question. That was the basic thing you need to keep in the mind. Now they are asking you the critical disadvantage. So option number A says that reinvest it at an IRR. So this is the specific limitation of the IRR, not the payback period method. So this is wrong. B says that complex discounting rate. Let me highlight the keyword complex discounting rate. So the traditional payback period method does not use discounting at all. So this is false. Payback period does not use discounting. So why there's option C says that incapable of yeah. First of all, let's look at D. It's taking that incapable of uneven cash flow. Here you can see uneven or staggered cash flow. This is completely false. You can easily calculate payback for uneven cash flow by just adding them year by year. But yes, option C is correct. It completely ignored both the time value of money and any cash flow generated by the project. Exactly. This is our exact answer. So to remember that this in the exam hall, how do you remember it? Think of the payback period as a selfish friend. Yeah, you can think of the payback period as a selfish friend. Imagine that you lend 1,000 rupees to this selfish friend. They don't care about the interest or inflation. They owe you for making you wait. Right? Ignore time value of money. The exact second they hand you back your 1,000 rupees. So this is you and this is your friend. You give them 1,000 rupees. So the moment he give you back 1,000 rupees, they walk away and stop talking to you. It ignore cash flow after the payback period. So whenever you see payback period disadvantage, just look for option that that describe this selfish friend. I hope that is crystal clear. So what we have discussed about in this particular session, in this particular question, we talked about the payback method. So the payback period measure the time taken to recover initial investment. Yeah, time taken to recover initial investment. And the flaw is that it ignored TVM, time value of money. It's completely ignored. And the second flaw is that it completely ignored all the cash inflow that occur after the payback period is reached, which can lead to rejecting highly profitable long-term project. That is the major flaw of the payback method. I hope that is crystal clear. Now, friends, have a look at the next question that we have. So the next question is regarding the Pradhan Mantri Jan Dhan Yojana age eligibility. So basically, the question is consider the following statement regarding the age eligibility criteria for the various facility and the Jan Dhan Yojana. Option A says that minor above the age of 10 year are eligible to open PMJDY account in any bank. B says that age limit for availing the OD facility up to 10,000 rupees is 18 to 65 year. Third option says that the life insurance cover under the scheme is available to individual between the age of 18 and 59 years. Right. Option they have given 1 and 2, 2 and 3, 1 and 3, 1, 2 and 3. These are the four options they have provided. Okay. So to understand this, imagine there is a family walking into a bank to take advantage of the Jan Dhan Yojana. Obviously, this is a scheme designed to make banking accessible to the absolutely everyone. First of all, let's look at the youngest son, right? Youngest son who is in the middle school. youngest son. Can he open an account? Yes. Under this scheme, a minor who has crossed 10 year of age can walk in, open and independently operate their own bank account. Secondly, let's look at the father, right? He wants to know about the life insurance cover provided with the account. Yeah, he want to know about the life insurance covered provided with the account. Okay, so insurance company usually cover people during their active working year. So the life insurance component is strictly available for adult. Is it how much? 18 to 59 years, right? Once you hit 60, this is specific life insurance cover end. Finally, the grandfather, he asks, what if I need emergency cash? Yeah, let's look at the grandfather. So we have father, you have youngest son. Finally, we have the grandfather. Grandfather asks, what if I need emergency cash? Right. So the Jandan account offer a overdraft facility. Yeah, they offer OD facility, right? So which is basically an emergency mini loan. You can think of this like a emergency mini loan up to how much? Up to rupees 10,000, right? So to make the scheme highly inclusive for senior citizen who might need medical emergency fund, the government extended the upper age limit for this loan. Yes, what government has done? They have extended the upper age limit for this loan, so you can get OD facility from 18 up to 65 year. Yes, very important thing. OD facility 18 to 65 year. Right. Now let's solve the MCQ. I hope we have gathered enough information. Right. So OD amount I told you 10,000. Right. Mini loan 10,000. Ages I told you 18 to 65 year. These are the points. Okay. So now friends, option. Let's look at the option they have given. Statement number one. What is statement number one? It says that that minor above 10 year can open an account. Yeah, we know this. This is true. Then again, the age limit for the overdraft up to 10,000 is 18 to 65 year. Yes, this is also correct. It was extended up to 65 year to help the seniors. And statement number three says that life insurance cover is available between 18 and 59 year. True. No, no, no. Yeah, it is also true because stop at least 60 year. So yes, our what is the correct answer? All 1, 2, and 3 are correct. So how do you remember it? Just remember this 10, 59, and 65. Right. AIO. A means account 10. Start at the age 10. I means what? Insurance. Insurance stop at 59. Overdraft stop at 65. This is how you can remember it. So whenever you think about the PMJDY question, just write down AIO and 10, 59, 65 on your rough sheet, and you will never pick the wrong option. So what we have discussed, that Jandhan Yojana, Jandhan account, a bank. This is a basic account which is available to minor above 10 year of age, and life insurance. I told you this is restricted to 18 to 59 years. Overdraft up to 10,000. Extended bracket from 18 to 65 year of age. These are the points which we have just discussed. Now, friends, let's switch our focus to the next question we have. Let's talk about the SLBC first. Yeah, standby letter of credit. This is a very peculiar question they're asking every year. So the question is, in the international trade and finance, the SLBC is widely used to mitigate this. Functionally and commercially, an SLBC is most similar to which of the following financial instrument? Commercial letter of credit, bank guarantee, bill of exchange, promissory note. Very good question it is. Right. So basically, to understand this, we need to know the difference between a primary payment and a backup payment. Yes, so to understand the meaning of this standby letter of credit, we need to understand the difference between two terms. One is called, primary payment, and the other is called the backup payment. So imagine that you are importing machine from Germany. Yeah. Imagine that you are importing machine from Germany. If you use a standard commercial letter of credit, right? Your bank tell the German seller, ship the machine, show us the shipping receipt and we will pay you. So what your bank tell the German seller? Your bank tell the German seller that ship the machine, show us the shipping receipt, and we will pay you. Here the bank expect to pay. It is a primary method of payment. You buy grocery, you swipe your card, direct payment, isn't it? Ship the machine, show us the shipping receipt, and we will pay you. That is what, right? Your bank tell the German seller. So obviously bank will pay. Primary method of payment. You buy grocery, you swipe your card, direct payment. But what if you are signing a long-term contract to build a bridge? Yeah. Suppose you are building a long-term contract, signing a long-term contract to build a bridge, and the government want a safety net in case you run away or go bankrupt. So government want, safety net. In this case, the bank issue, SLBC, or we call it a standby letter of credit. Okay. SBLC, sorry. SBLC. The bank tells the government, we don't expect to pay you anything, but if this contractor default or run away, we will step in and pay the penalty, right? So you are signing a long term contract to build a bridge, and the government want a safety net in case you run away. So in that case, the bank tell the government that we don't expect to pay you anything, but if the contractor default or if the contractor run away, we will step in and pay the penalty. So that means SBLC is a dormant. SBLC is a dormant, right? It sleeps. It only wake up when there is a default. Yes, when it will wake up, whenever there is a default, then it will wake up. Now does this sound familiar? Yes, in India we simply call this BG or bank guarantee, right? So why the different name? Historically, banking law in the United States strictly stopped their bank from issuing guarantee. Please understand, historically what used to happen, that banking law in the United States, in the US, right? They strictly stopped their bank from issuing guarantee. They no longer issue guarantee. So American banker found a clever loophole. They just took the rule of a letter of credit and call it a standby letter of credit to do the exact same job. Okay. Now let's look at this question that they have provided. Right. So the question is, in an international, functionally and commercially, an SLBC is most similar to which of the following financial instrument? Commercial letter of credit, first option. Bank guarantee, bill of exchange, promissory note. So if you look at the option A, this is completely wrong. This LC, commercial LC, this is the primary payment tool. What is this? This is a primary payment tool. What about the option B? It's all about bank guarantee and promissory note. This is another wrong, because these are the just basic promises to pay between two parties, not a bank fail safe. And the option C say bill of exchange. Yeah, this is about the correct answer. You know, both serve as a secondary fail safe mechanism, right? That only trigger when someone breaks a contract. So to how to remember this easily in the exam hall, think of the standby power generator. Yeah, you can think of a standby power generator. Does a standby generator run all the time? No, it only turns on when the main electricity fail. Similarly, a standby letter of credit only turns on when the main payment fail. It guarantee the power. It guarantee that power will stay on. So a standby means backup. Backup means guarantee. This is how you can remember it. How to remember this? A standby, which means backup, and backup means what? The guarantee. Okay, so whenever you see this SBLC, instantly match it with the bank guarantee. I hope that is crystal clear. Obviously, no. This is the correct answer. Bank guarantee is the correct answer, not bill of exchange. So see, commercial LC is a primary payment mechanism. Standby LC is a kind of secondary fail-safe mechanism, and SBLC legally and functionally the exact same thing as a bank guarantee. It is only triggered, right, upon non-performance. Please understand. Now, friends, let's look at the next question we have. This is regarding the credit administration and compliance at a XYZ bank. This is about the CRILC reporting. Okay, so let's go through this particular question. So basically, imagine that a question scenario is like this. The bank data team is preparing a CRILC, that is Central Repository of Information on Large Credit Submission. During the data extraction, the system flagged two large exposure, 6.5 crore crop loan granted to a large agriculture partnership, and 12 crore short-term interbank exposure placed with another scheduled commercial bank. The data analyst is unsure whether these should be included in the final CRLC file or not. Now let's look at the scenario number two. Concurrently, the corporate desk receive a proposal from Apex Infrastructure Limited. Obviously, this is the civil contractor. The company requests the bank to issue a performance bank guarantee in favor of a government authority. Due to the massive scale of the infrastructure project, Apex Infrastructure insists on a guarantee validity terms of 12 years. These are the two scenarios. Now the question is, based on the RBI guideline for CRILC reporting, how should the data analyst treat the 6.5 crore crop loan and 12 crore interbank exposure in the scenario 1? Both must be reported to CRILC since their individual limit exceed the reporting threshold of 5 crore. Only the interbank exposure is exempted. The crop loan must be reported because it is an agriculture advance. C says that both the crop loan and the interbank exposure are completely exempted from CRILC reporting. D says that only the crop loan is exempted. The interbank exposure must be reported to track systemic risk. These are the four options they have provided. Very good question it is. Have a look at the scenario. So how do you go about solving this problem? So you can imagine the CRILC as a giant secret WhatsApp group. Yeah, you can imagine this CRILC as a giant secret WhatsApp group where all the bank in India warn each other about the big borrower. Yeah, so they warn each other about the big borrower. Okay, so suppose if a company take a huge loan from you, you have to announce it in the group so that other bank know the company total debt, right? Suppose there is a firm and they have taken a big loan, right, from you. So what you have to do? You have to announce that. Where you have to announce? In that WhatsApp group. Actually, that WhatsApp group is nothing but CRILC, right? So that other bank know that company total debt. So now the question is, what qualify as a huge loan? When we will consider a loan as a huge loan? Yeah, the RBI says that any exposure of 5 crore and above, right, must be reported to CRILC. But here is the twist. The RBI created this system to track massive corporate and commercial default. Yeah, the main reason of creating this system was to track the corporate and commercial default. That was the main reason. Corporate and commercial default. They are not trying to track agriculture risk. They are not worried about bank lending to another bank. Yeah, this I'm again telling you, they are not concerned with the agriculture risk, and they are not worried about the bank lending to other bank. Because of this, RBI made a strict rule, and what is that rule? That a crop loan and interbank exposure are completely exempted from CRILC reporting. Very important aspect. That you need not include the crop loan, right? And you need not include the interbank exposure because they are made, this system is made to track corporate and commercial default. Okay, so it does not matter if the crop loan is 100 crore. If it is crop loan or loan to another bank, it does not go to the CRILC group chat. Okay, now let's look at the MCQs that we have given. Let's look at the scenario, right? So the first case they have mentioned the 6.5 crore crop loan, right? And the second case they have mentioned the 12 crore short term interbank depo exposure. So both of these amount are well above the 5 crore limit. As you can see, both of these are well above the 5 crore limit, right? So the analyst is confused. Should they be reported? So let's look at the option. Option number A says that both must be reported to CRILC. Again, this is incorrect. This ignore the exemptions rule. And B and D, if you look at, one of them is exempted. It's saying that only one exempted, only one exempted. This is wrong, right? C says that both are exempted. Exactly. This is our correct answer. The amount simply does not matter because the category of loan is exempted, right? Crop loan and interbank exposure are completely exempted. So how to remember in the exam hall? So to remember this in the exam hall, just use the simple memory trick that farmers and friends are free. Farmers and friends are they are completely free. Please remember it. So farmer, when I say farmer, I mean to say crop loan. And when I say friends, I mean to say other bank. And when I say free, free means CRILC reporting. Free from what? Free from CRILC reporting. That is the point here, right? So farmers and friends are free. That is the point to remember. Now, friends, have a look at the next concept that we have. So the next concept is 10-year limit on bank guarantee. That is what the question is based on. Okay. Let me show you the first of all scenario here. Now, friends, in this particular question, that is question number two, right? This is the part two of our previous question, and the question is telling regarding the Apex infrastructure request in the scenario two. What does the RBI Master Circular on guarantee stipulate regarding the maximum tenure of a bank guarantee? Option A: bank are strictly prohibited from issuing any guarantee with a maturity exceeding 5 years. Option B: no bank guarantee should normally have a maturity period of more than 10 years. Option C: bank guarantee issued to government department have no maximum maturity limit provided a 100% cash margin is maintained. And option D: a bank guarantee must strictly adhere to the maximum maturity of 3 years to align with the Limitation Act. These are the four options they have provided. Now, friends, how do you go about solving this problem? So let's look at the 10-year limit on the bank guarantee. So let me give you a simple example. Imagine that your friend is renting an apartment and the landlord asks you to be the financial guarantor. You agree to sign the paper. If my friend does not pay the rent, I will step in and pay. Right? So this is your friend. And what he is doing, he is renting the apartment. Okay. So basically, what he is doing, renting an apartment, and the landlord, yeah, the landlord, he asks you to be the financial guarantor. You agree to sign the paper, right? And you say that, if my friend does not pay the rent, I will step in and I will pay. You might be comfortable taking on this risk for 1 to 2 years, isn't it? Because you are taking the risk. If your friend is not paying, you have to pay. You might be comfortable, taking on this risk for 1 to 2 years. But what if the landlord asks you to guarantee your friend rent for the next 20 years? Yeah, suppose the landlord asks you to guarantee your friend rent for the next 20 years, you would immediately refuse, isn't it? You will refuse. Why? Why will you refuse? Because you have no idea what your financial situation will be 2 decades from now. Yeah, you have no idea of your financial situation, isn't it? Bank face the exact same problem. Whenever a bank issue a performance based guarantee, we call it PBG. Suppose this is a bank and the bank have issued PBG. They are taking on contingent liability, right? They are taking on what? Contingent liability, right? So that is a kind of hidden risk that might suddenly become a real loss. So if the bank lock itself into guarantee for 12 year, 15 year or 20 year, it severely messes up their long term safety, isn't it? Their long term safety will be messed up, right? And the asset liability management. So because of this danger, the RBI act like a strict parent. Yeah, the RBI act like a parent here. The master circular set a general ceiling that a BG should normally not have a maturity more than 10 years. So the BG maturity should be less than or equal to 10 years. While exception exists for massive infrastructure project, issuing a guarantee beyond 10 years is rare and require a very specific special approval from the bank board or director. Now, what the question is asking you, have a look at the question. So basically, it is telling that RBI Master Circular stipulate regarding the maximum tenure of the bank guarantee. Option A say strictly prohibited, right? Strictly prohibited from issuing, from exceeding 5 years. So this is incorrect. 5 year is too short for most project. He says that no maximum limit if 100% cash margin is maintained. So again, this is incorrect because even with the cash margin, bank cannot carry indefinite contingent risk. Now option D says maximum of 3 year to align with the Limitation Act. Again, this is incorrect. The Limitation Act governs the filing of lawsuit, not the guarantee tenure itself. What about option B? It says that no bank guarantee should normally have a maturity period of more than 10 years. Yeah, this is exactly our correct answer. Okay. So how to remember for the exam? So you can remember it, just memorize the phrase. And what is that phrase? The decade deadline. The decade deadline. Just remember it. Okay. So decade, decade is exactly 10 years. So whenever a question asks about the maximum normal maturity of a bank guarantee, just remember that bank don't like carrying risk past a decade. 1 decade, 10 year, that is simple. Okay. So what we have discussed, we have talked about the general rule that bank guarantee should normally not exceed 10-year maturity period, first of all. And the reason is simple, to prevent bank from carrying contingent liability and long-term exposure indefinitely. And guarantee beyond 10 year can be issued for long-term project, but they require board approved policy to manage ALM mismatch. Yes, board approved policy is needed. So friends, we have more questions available for which we have collected, and explanation for this question will be available in our paid course. For more detail, you can WhatsApp me on this particular number. If you want me to bring the part 2 lecture of this particular session, just write yes in the comment section. If I get enough number of yes, I will bring the part 2 session immediately. Thank you. I hope this session help you to clarify the basic concept. Meet you in the next session. Thank you. Have a very nice day.